India faces a significant challenge to its financial integrity from the increasing number of non-performing assets which are affecting the banking system. At least 7 of 21 state-run lenders are under the Reserve Bank of India's Prompt Corrective Action Plan. It is forecasted that by March 2018, the gross bad loan ratio will rise to 10.2% of the total loan book from 9.6% in March 2017. While the government has taken measures such as the introduction of a new Insolvency and Bankruptcy Code, IBC, there are several challenges which still persist.
I think the key question is, if a resolution plan is approved, will the bank then be able to treat the asset as standard? RBI should probably come out with some guidelines on this point, which will encourage and influence how the stakeholders will come up with a resolution plan. At the end of the day, the banks want to get the asset back as a standard asset, and currently that thinking is yet to develop, and it will be good for the RBI to give this guidance upfront so that the banks can be mindful of that when they decide competing resolution plans.
The International Monetary Fund's financial soundness indicators illustrate that India ranks poorly on NPA resolution, particularly among Asian economies. However, the question remains, are we failing in standards, or is it that our stringent policies account for greater disclosures and hence affect our ranks when compared to the Western counterparts?
Hello and welcome to another episode of India Risk Report. The RBI's Financial Stability Report has warned that the bad loans ratio in India by 2008 March could jump to 10.2% of the total loan books from its earlier figure of 9.6% of March 2017, and this could go up to as high as 11.2%. So to look at what could be reflective of the fact that these bad loans continue to be in effect in India, and what could be the immediate actions that we need to consider in our economy, which will be also attributable to addressing the fundamental reasons behind that, and what could be the way forward after the immediate actions. We have two eminently qualified experts with us on the show. We have Mr. D.K. Mittal, who is a former MD of IINFS Infrastructure Development Corporation and former Secretary of Department of Financial Services, Ministry of Finance. At the same time, we also have an eminent independent expert, Sagarika Chakrabarti, who is the CEO of Iris Consulting. And I'll go to you, Mr. Mittal, first, sir. Can you give us the big picture that what is it that is worrying about the state of affairs with the bad loans, the NPAs, and something which successive governments have not been too keen to address and catch the bull by its horns? What is the problem?
See, today NPAs are touching, as RBI said, about 10.5%. Now that puts a limitation on the bank to lend money, because that takes away the capital and that blocks the further flow of money to the public at large. And therefore, government is very concerned that for the growth of the economy, you need lending, and public sector banks, which are touching about 70% of the banking sector, they can't lend. And this is the third time in the last 25 years this is happening, that our NPAs are touching 10+%. So I think that's a cause of concern for that perhaps.
Okay, Sagarika, now, I mean, going straight to your area of expertise. Now, obviously, this is a risk factor for our economy, and this is something that needs to be mitigated. Now, where do we start with the NPA situation? Because from what I'm trying to understand is that they are all interlinked. So it is not that you address one set of problems and everything else will fall into place, but you have to have a sequential series of measures and some very harsh measures to come to grips with this whole mounting debt that adds with the financing and refinancing of NPAs and the various financial initiatives which seem to have caught everybody in a whirlpool kind of a situation.
So, Maruf, the first thing or the first step is to understand that traditionally we've known that NPAs are attributable to business risks. We need to move away from that understanding and understand that NPAs are broadly not only financial risk or business risk, but they are more towards strategic and operational risk that tie not only the banks as stakeholders, but even the regulators, the industry experts, the people who are litigating out there, everybody has a role to play. And once we understand the role of these stakeholders, comes the second thing of having critical intelligence pertaining to the loans be available to them. Know the borrowers to whom you are lending. Have an insight into what is the money going to be used for. Once you have that, it is much better and easier to take a call, and you can even have the bad loan provisioning, because ultimately it is a risk. But the question is that instead of trying to see that there is no risk at all, why don't we mitigate risk and try to reduce it?
Okay, that's interesting. Back to you, Mr. Mittal. Now, you see, one thing that she mentioned more than once in her statement is loans and banks. Now, quite clearly, really much of the buck has to stop between the finance ministry and the banking system. And the banking system in India has been a cause of worry, I'm sure, to people like you, but more importantly also to the layman. Now, for every 100 rupees that a bank lends out, they recover about 88 rupees worth of the principal amount. This can be even higher in cases where the loans are not recovered at all. Yes, total recovery, as you educated me before the show, is a little higher than this figure, maybe 125 to 100 rupee lent out. So, if the total recovery is higher than the amount lent out, is the banking system something that we can blame to say that you are really one of the main issues behind the non-repayment of loans, because they are recovering the money? So, where is the recovery problem? A. B, the problem that also comes up is that why is it that we continue to keep reinforcing an idea which is a failure? Are we short of ideas?
Yes, a non-performing asset is something which happens globally. It is not something unique to India. And we, as a developing economy, we keep on passing through various cycles. So this is also one of the cycles we are passing through it. The banks, when they recover money out of NPAs, it is only with the time lag they recover money. Ultimately, NPA is not something where the asset has gone bust. It is only that temporarily the asset has been incapacitated to repay the due amount to the bank. Now, most of the time, these NPAs are recovered, and very little amount, generally about 1 or 2%, which is ultimately written off, which is basically a last loss to the bank. So when we say 88% is only at any point of time, but at any point of time also recovering old NPAs, and I'm also creating new NPAs. Now, banks, when they earn 120%, 180%, they have to pay out of the money they have got from depositors, and also meet their expenses, and also made provision for this. So they create a lot of reserves as per the requirement of RBI and international standards. So ultimately, when this situation becomes bad, that they have to make more provisions, they have no capital, and therefore they come into a bind, into a vicious cycle of they being put under direction, and they can't go forward. Now, that is a scenario which some of the banks have passed through. But let me just say that it is mainly a problem with large number of public sector banks, where large number of other issues are associated with these NPAs, and we do not find same situation in private sector banks. So the question basically would be how to deal with public sector banks.
Okay, public sector banks, but I mean, there would always be the requirement for tighter laws. I mean, that was what we were discussing earlier, that and I think Sagarika also has a very strong view on that, that from a legal position, the current laws, are they adequate to deal with the kind of situation that our banks are faced with in the NPA situation? And is there a effective legal situation that we can impose on those who are defaulters, leading to banks coming into a bit of a tight spot? Or is there a disconnect in between what the laws say and what is implemented or can be implemented?
You've hit the nail on the head with that last statement. It's not that there is any deficiency in the number of laws or the kind of laws that the country has. I think we have a very robust legal policy system that really covers on a plethora of issues and especially tackles the NPAs very, very strongly. If I go back to the RBI policy, every year RBI revises the policy. But unfortunately, the seepage down, okay, it's all a trickle down or a waterfall system. That seepage down to the ground level in terms of training, in terms of awareness, or in terms of basic information collection is never there. And so once your set of files are never complete at the base level, how do you represent and how do you defend yourselves in the court of law? So it's all basically connected. The law clearly maintains a lot of stringency, but the same is not being implemented. And unless we really stop blaming that we don't have adequate laws and start waking up to the fact that the laws are there but they are not going to implement themselves, the policies are there but they are not going to be read out themselves, and we have to take some onus ourselves to educate the people around us.
Good point, sir. But then again, I go back to harping on an issue which I have spoken about earlier, that bad loans in India are approximately 10 lakh crore or $154 billion worth as far as the bad loan situation is in India, and it is growing. And put it in a relative context, this is more than the GDP of about 137 countries. Now, when you look at the situation that loans are continuing to rise, it's going to impact on the GDP. Can I have it with you, from you in simple terms? How is it going to impact on the GDP in numbers? Say, supposing the GDP right now is a certain percentage, is the percentage going to dramatically fall if the bad loans remain unaddressed?
See, a simple calculation could be each investment has certain contribution to the growth of the economy, as they call the value added. Now, if you look at any X amount, then generally in this industry, which will be small and medium to large, you could take 2x to 3x is the kind of contribution it will add value. And to that extent, one can easily calculate that this amount of 10 lakh crores, how much contribution is making to the slowdown of the economy. That's very clear there. But more importantly, it is also affecting economy because the employment in these industries is now almost dead. Then thirdly, those who are supplying to the industry, they are also affected. So it is a cascading impact on the economy when you have such a large pool of NPAs. And to that extent, it creates a distress in the economy, and therefore the resolution to that extent becomes so important.
Well, very important points raised, and we have to go in for a break because of shortage of time, but quite clearly, the banking and the connect between them and the NPA dinosaur that continues to be there in our economy needs to be addressed more. But we'll come back after a break to look at issues related with how we can continue to address sector-wise issues if there are best practices available, how India can learn from practices elsewhere abroad, and what is the way forward. That after a break. Welcome back. We continue to have our two experts with us, and we are looking at the real major problem to the Indian economy and the challenges that we face with non-performing assets. We continue to have our two experts, and Mr. Mittal, sir, I'll go back to you and I'll try and, can you throw a little light on the sectors that cause concern to you? I mean, some of it we get to read through the media. I mean, the real estate sector seems to be worrying, but again, there are steps that are being taken to penalize those in the real estate sector who have not lived up to their promises. But something that is in the air also is the fact that most of the borrowers don't deal with one bank. So therefore, how do you address this problem of multiple lenders in some major sectors? And in some major sectors that I'll come to Sagarika eventually to ask, what are the cases where the lenders continue to lend to defaulters?
So if we look at key sectors where we have NPAs today, let us start with infrastructure including power. Then you take second stage would be real estate. Third would be something in chemical sector, chemical industry. Then of course there is something in textiles, and of course diamond jewelry, mining. These are the segments which cover about 80–85% of the NPAs of the country. Now they will have a spread in terms of some of the sectors would have a small SME segment, but some of them will have predominantly medium and maybe large industry. Now the problem of each sector is different. So in power sector today we have lent money to borrowers who did not have power purchase agreements, who did not have power evacuation systems, who did not have water supply, and the money was lent to them. Similarly, in infrastructure, now there are typical cases where the road projects were financed with the land was not fully acquired by NHAI or by them, maybe 10% is acquired. They did gold plating, they took money, they took contract in the name of their group company, did the gold plating and put the same savings here as equity, and they did not have any skin in the game. So there are a large number of such cases there, which has happened. Now the problem today is that if there are multiple banks which are lent to these borrowers, those banks never come together to any unanimity, because everybody is watching their own interest, sometimes in the interest of the institution, sometimes interest beyond the institutional interest. And therefore, borrowers are smart enough to play one against other, and they do not let things settle down to one place. And that's one of the reasons why we are not able to resolve NPAs.
Very interesting. So, I mean, one playing against the other, and obviously in the financial world, beyond everything else, people will guard their own interests. But Sagarika, to you, now, you in your role as CEO of IRIS do look at some very specific case studies, and you also do give out reports which work as warning signals to others, in which you tell people, or you tell investors particularly, that what is the state of play in the market in India. Now, could you highlight some of the case studies? Because from what I've gathered is that defaulters may be declared defaulters by certain banks or go out in the media, but they continue to draw investments. They continue to get in investments. How is it that it defies my common sense that when somebody has been unable to play somebody else, why would I lend you more money?
So, Maruf, going back to the basic guidelines that RBI puts out when it comes to the entire financial sector is the know your customer. I think banks, or rather all financial houses today, need to really wake up to say that it is not really a customary check. You really need to know your customer. And we've had situations where we've gone and tried to warn banks to say that please don't get into any more kind of renegotiations with this particular borrower, mainly because he's planning to flee the country. His family is already out there. He's already he's already resigned his citizenship. And the bank has been like, what are you saying? We just did a restructuring deal with him and he is all on track to repay us. 2 weeks down the line, it's all over the media that the guy is out there in some of the tax havens and he is not even a citizen of your country that you can get him back. Similarly, we had another situation where the investor comes to us and says, I took a collateral, but now it looks like that I cannot really, put it to use. We said, well, did you check the collateral? Because we had given that recommendation. Well, I did not. Well, the situation was that the borrower had used the same piece of land 5 years back with another investor and given that as a collateral. So it was like a childhood crocodile story, that same crocodile, baby crocodile being shown over and over again. So that's the situation. Know your customer, but know it truly.
Well, I mean, alarming signs, but people are continuing to push a particular line, knowing, and it's amazing that banks in particular have very competent boards, I would like to assume, and but nobody seems to read the writing on the wall. But I'll go to another issue, sir. And India is constantly being reflected because of what the case study she just brought out, and as you are familiar with, as a poor performer in NPA rankings. But at the same time, it is not unfair to say that when compared with other development countries which have bailout laws, our laws or our ability to enforce those laws is perhaps not as effective, or sometimes our legal system has not built in the kind of case studies that we are now encountering. So how do we fare when compared to other economies? How does it impact on investor confidence in India? How does the international community look at India as, is this somewhere that they'd like to put their money in still? Despite these figures, which you know only too well, every researcher worth the name would have all this data available to them sector-wise whenever somebody wishes to come in with a few $1 billion to invest.
Yes, I think the legal system or legal framework, as to say, what we have is more than adequate. Of course, it is never perfect. But the main problem is how do we implement it and how expeditiously we implement it. That is the biggest challenge. So if we take the first call, which is the debt recovery tribunals, they are extremely slow. there is enough scope to improve their productivity and efficiency, that self will take a lot of pressure from the other systems. Then from there, the cases go to High Court, because we do not have still this concept of separate economic judicial system. Within the same judiciary, you have a specified, qualified expertise available for economic aspects. This is not there in our country, while we have such a large GDP now and we are growing so fast. So there's a second problem. The problem from investors' perspective is, I fully agree that they would look at India as a risky country, but they know pretty well that which sector, subsector to contribute to invest and which not to contribute, which not to invest. They know it very well. But overall, investors' investment to India will slow down, because this will be coming to very limited sectors and subsectors and not to every other sector. So that, I think, is a challenge for us. But we being such a large economy now, I think the NPA resolution is a very fundamental issue, and this vicious cycle cannot be broken unless we have a takeout where the NPAs are put into some vehicle which are taken out from the banks and they are resolved, and then you get global investors into those sector-specific entities, and that's the only way to resolve it. And lastly, we have done it in 2000, 2001 when we had the UTI 64 problem, and we have come out of that very, very well. So I think we have a case study. And same thing has happened in other countries. Wherever their NPA programs have risen, they only found out a solution where the government has to step in and find a solution to those NPAs which have accumulated.
See, Sagarika, I see that countries like China and Japan, I mean, two economies, and even Korea, the three big sort of role models in Asia, they have their own set of initiatives in place where they address the problems which are unique to them. Now, some of the problems that are unique to us, I mean, something that comes to me from the top of my head is the agricultural loans and the loans to the agricultural economy, because it's a very big part of our economy. And for political reasons, these loans are very often waived off. This has a direct impact on our GDP in the long run. So, is there something that we can suggest in terms of use of better technology to get a drift on really what is happening on the ground? For instance, we are a pioneer in satellite technology, but can satellites help us get somewhere there in getting, because your expertise is largely on understanding the risk, and if the risk is understood, then you can give out warning signals. Whether people adhere to that or not is another issue, and I'm sure you give out the necessary warning signals. So what are the kind of warning signals that you would traditionally give out in big sectors where you see that these are something that we need the government? Because Mr. Jaitley, the finance minister, has been on record to say that there are bad loans are due to projects in power, infrastructure, mining, steel sector. And if you look closely, many of these companies that are in the space are some of the biggest industrial giants in India, whether it's Reliance, whether it's Adani, whether it's Vedanta. So how do you catch the bull by its horns? There is that agricultural challenge and there is the big industrial challenge. Both cases you're dealing with huge, big financial undertakings. And how do you address it? One, the government is sensitive about, one, the corporate sector is sensitive about.
So I think the government is sensitive about both the sectors, which we call as priority as well as non-priority. And if you really see, that is why we know that the agriculture is the backbone of the economy, okay? But when we talk about the agricultural loans and we compare it to the kind of corporate loans, Sir would be a better position to, give out the numbers. But then again, it actually forms a very minuscule percentage. And when we look at it, is it really that worrying? No. But when we come to the corporate sector, yes, it is indeed worrying. But I guess the kind of steps that has been taken in order to say that a borrower is a borrower. It is defined by a creditworthiness. It is defined by the kind of ratings. So the first thing that RBI did a couple of years back was to cut out the middleman. That if a corporate has to submit a proposal, it needs to come from the corporate and not somebody who will stand in the middle and say, hey, I'm a lobbyist who knows this corporate well. Or do you know whose connections it is? So banks today are waking up to say that we don't care whose connections you come with. We don't want to entertain calls referring you. We want to see how creditworthy you are. We want to have a look at your collaterals. And I guess once this kind of a professional approach in dealing with the person who's sitting across the table and only referring to creditworthiness on numbers, only referring to facts, without considering that there is a clout of influence comes into place, things are only going to get better.
On that happy note, I need to wind up the show purely because of shortage of time. But one thing is very clear from what our experts have brought out, that I think the government and the banks and many others are seized of the problem. And it is only a matter of time when more corrective steps will be put together to address this giant challenge of NPAs and how it may impact negatively on our economy if we don't put those steps together. Thank you very much for being with us on this show. We'll be back next week with another episode. Until then, goodbye.